On the Tape is presented by CME Group, where risk meets opportunity. iConnections, reimagining how the investment industry connects, and SoFi. Get your money right all in one app.
Welcome to the Monday edition of the On the Tape podcast. I'm Dan Nathan, joined by Guy Adami. Guy, how are you?
I'm all right. Look, tough weekend, obviously. Let's not bury the lead. But as I tweeted out right after the final horn went off, the horn that basically was the sound of Ranger fans putting to bed another season, Panthers were a better team. The Panthers were a better hockey team. So I take some solace in the fact that they played well, but they lost to a superior squad. We'll see what happens now in an Edmonton Panther Stanley Cup final.
Yeah, it should be great. And you just got to give a shout out to Igor. I mean, as you would say, Guy, he stood on his head for 6 games or so. And that goes back to the other series. He was the man. We still have next year. Guy, we got a lot to cover here. Cover Barron's always kind of interesting to see what they suggest. Some people think it's a contrarian indicator. They're saying the Fed rate cuts won't happen this year. We're talking a little bit today about consumer spending. We have some manufacturing data out this week. Earnings are getting a little light. Our main man, Jensen Huang, was over in the, somewhere in Asia talking up their new chips and their new platform. It's got, as we are recording right now, right before the opening, Nvidia bid up 3% or so. AMD announced some new chips, so we'll hit all of that. And then kind of the narrowing in this rally, I thought there was some really interesting divergences last week as tech was coming off. Some of these other sectors were doing pretty well. We had yields come in a little bit, but we got to start here, Guy. What the hell happened Friday afternoon at 3:00? It really looked like the end of the month action, not particularly great. A few bad days in a row for the tech-heavy NASDAQ. Some of the big leadership was leading to the downside. We had some high-profile software blow-ups, and at 3:00, I think a little after 3:00, it's like the NASDAQ was down 1.5%, and before I looked up, it was basically unchanged. The S&P was also down 1%. So what happened here?
I think that's exactly right. You hit the nail on the head. I think it was a combination of, we see these rebalances from time to time, which have lost some of their zest in terms of the impact it has on the market, but nonetheless, they're out there. But the month-end markups continue, and we seemingly see it every either month-end and or quarter-end, and it's real whether people want to acknowledge it or not. I mean, that's basically what happened. So in the last hour of the day, to your point, a market which had been, I don't want to say floundering, but under some pressure, obviously came raging back. So we'll see if there's a follow-through. There was some damage done over the last week and a half, and I know people don't want to talk about it, but just in terms of the Dow Jones Industrial Average and in the form of a couple different things, we'll see if that manifests itself into the S&P 500. But to your point, Nvidia back on its horse today on the back of some of the comments over the weekend. So everybody's excited. I know Jim Cramer put out a tweet earlier. He's excited about what's going on. He said he had to listen to that, basically, I guess not speech, but presentation that Jensen Huang gave a couple different times, and he was impressed by it. So there's still a lot of enthusiasm out there with that question.
Yeah, CNBC had an article out over the weekend. S&P 500 enters June near a record, but with growing concerns about the market's narrow leadership. You could have said that at any point over the last 2 years. If I had $1 for every time I said it, I probably wouldn't be doing podcasts anymore, Guy. They're obviously spending some time talking about Nvidia. This has gained, $1.5 trillion in market cap over the last year and a half or so. It's become, the second or third, I guess the third largest market cap stock behind Microsoft, Apple. And let me tell you something, it really feels like it's about to overtake Apple, which would truly be astounding. But this article also talks, what I just kind of alluded to, Guy, is like this kind of expanding breadth. I'm looking at my main fact sheet screen from last Friday, and I saw banks raging. Bank of America was up 3.5%. JP Morgan back near its highs, up 1.5%. I see a bunch of autos. Look at GM and Ford. We're both up at least 3%. Some other industrials, Guy. So, this was kind of broad-based. It was kind of interesting. Also, I'll just highlight pharma stocks were raging. Telcos, Verizon up 2%. AT&T up 3.5%. This is all Friday. Does this have to do with yields, which have come in from 4.65, and here we are right now on the 10-year at 4.46?
Yeah, I mean, again, bond volatility is back in spades without question. 435 up to 463-ish, back down below 4.5. on the back of a number of different things. Again, are lower rates a good thing or a bad thing? Are they going lower because things are calming down on the inflation front? Are they going lower because there are some growth scares out there? Listen, I clearly don't know the answer because I've been dumbfounded by the entire thing. But to your point about sort of broadening out, yeah, I mean, you can pick a handful, 15, 20 or so names and say it's seeming like the market's broadening out. The problem, of course, is with the size of the companies you just mentioned. I mean, they are the game, right? So you can pick 30 names out there, and they're not going to come close to equaling the size of the three names you mentioned before. So as those stocks go, regardless of whether or not people want to acknowledge it, so goes the market. So we'll see. There is obviously excitement once again around the semiconductors for whatever reason. They seemingly continue to rally on similar news over and over again. And I'll say incorrectly because it's been incorrect for a while. I mean, I just don't know how long that type of phenomenon is going to last. And, this is still, the last I looked, an extraordinarily cyclical industry that people think is no longer cyclical, and there's some sort of paradigm shift.
Yeah, it's interesting. AMD releases, some new chips today, or they're talking about them over the weekend, and the stock's up 2%. It's obviously still down considerably from those recent all-time highs from a couple months ago, but I think you have to go back. I mean, I heard you say this, well, for 2 months leading up to their April 30th, okay, Q1 report, you were going back to the Jan 30, Q4 report when the stock, gapped down considerably and kept on going lower on a worse than expected report. And, it's important to remember when they reported their Q1 and gave Q2 guidance, the stock was down 9%. You know what I mean? So, this stock takes one step forward, two steps back. So again, I think the leadership in the semis has become really narrow between Nvidia, Taiwan Semi, Qualcomm just joined the party a little bit. But to your point about market caps, Micron's market cap doesn't matter. You know what I mean? Like there's a handful of others. So I think that's really important. Listen, I'll just say this. I said this on Fast Money. At some point over the next few quarters, you're going to have a down 20% day in Nvidia, and it's going to take a lot of other stuff with it. And, case in point, look at Dell. Dell was like one of these adjacent plays, right? That are making, the servers that are going into the data centers, that sort of thing. It just went parabolic over the last few months. And the stock was down, 20 some percent after it reported its quarter, And then there's some of these adjacent names like MongoDB, which you would expect some of these application software names to be participating after its results on Friday was down 23%. So investors are shooting first and asking questions later. And the point about Nvidia, people on the Twitter or whatever, they say to us, Guy, when in response to some of the videos here, Market Call, or on Fast Money, oh, you guys have been short for blah, blah, blah. We haven't been short. Okay. What we're trying to do is kind of highlight that, yes, the euphoria can continue to go on much longer than any rational person expects. But when it comes undone, don't mistake, you know what I mean, a mini sell-off for something that could really snowball into something that overshoots to the downside the same way it's overshot to the upside, Guy.
On May 29th, I think it was May 29th, and, again, you want to go back and fact check me, but Dell made an all-time high of about 179.70. Post earnings, it traded down to 131 to your point. And that is over a 20% move in one fell swoop. And it's not an insignificant company. I think at one point Dell was, over $100 billion in market cap. Obviously nothing compared to the names we talk about, but, just to your argument, you can see moves like of that magnitude. I mean, it obviously took a number of months to make that move from the current levels to that 179 and change, and it gives it back in a day and a half or 2 days. So yes, anecdotal, but anecdotal in so much as we're seeing it across a swath of different industries and a bunch of different companies. So we are seeing right now an environment where stocks continue to take the stairs up without question, but that elevator down has been precipitous and scary. And again, it has not manifested itself in the broader market for whatever reason. Again, I'm not able to sort of understand that, but when you see over and over again the magnitudes of some of these moves to the downside, we're not seeing, and we've seen it before, we're not seeing nearly commensurate moves to the upside of that magnitude anymore. So it's just something to look out, I think, in the future and just sort of take into consideration, because if it can happen to one stock or a handful of stocks, it's safe to say it could happen to a sector or potentially an indice as well.
Yeah, no doubt. I mean, to your point, at the start of March, Dell was $90 or so, and just last week it got as high as 180. So here we are with a stock at 140, traded as low as 130. You could say people got shit rich on the upside, but the truth is nobody sells. I mean, this is the point that we make again and again. You know what I mean? Nobody sells, and I mean retail for the most part. And we can just look at this GameStop again. It's up like 70% today because Roaring Kitty puts out a tweet last night. And my only point is, if you just looked at the way GameStop traded from below 20 up, what was it, up a few 100% or something like that, it round tripped the whole move. And then this jackass comes back with another tweet that's saying he owns 5 million shares and a whole shitload of June calls, and he's got the stock up 70%. So he's become a self-fulfilling prophecy. If you think that is bullish price action in this market, our friend Doug Cass has a note out this morning saying the stock market is casino. And when you see that sort of price action, or you see it, in a stock like Dell double in 3 months and then take off 25% in 2 trading days, just do the math on what the 25% is from $180, you know what I mean, relative to the gap up last quarter when it gapped up 30%. This move is much bigger, although it's a smaller percentage. So again, it's just math here, people. And I just want to make the point is like, this is a great quote from the Wire guy. You remember Omar when he says money ain't got no owners, only spenders? Well, you can't spend it unless you book it. Okay. Like that's I'm just kind of adding on to what Omar said. He said that to Marlo in this amazing scene. You should watch The Wire, by the way.
I've not seen, unfortunately, another series, sitcom, whatever that
Not
I've
a
not.
sitcom. This is one of the best crime dramas that has ever been on TV. It was on the HBO I think it launched 22 years ago, June 2nd. So yesterday. All right, guy,
Wow.
we got to get to the cover of Barron's. And I thought this was kind of impactful. The Fed won't cut rates this year. It went on. We don't need to go through all the reasons. You know what they are here. Again, a lot of the calendar has something to do with it. We've been looking at the CME Fed funds tracker and how it's basically pushed out any cuts, like the probability, you know what I mean? Like nearing, let's say 35% to maybe September, maybe November. I guess the Fed's meeting, guy, in November starts the day of the election or so. So the likelihood that you get a rate cut there is not particularly great. So really the odds are just moved to December. And if it's only 25 basis points, it's not going to matter anyway. Thoughts there, guy?
Yeah, I think that's best case scenario for the market, to be honest with you. Again, we've said it dozens of times on this show and on Fast Money. Be careful what you wish for because you might get it. And I just saw, again, we're doing this Monday morning. I just watched Nick Timiraos on Squawk Box talking about the Fed and the potential for the soft landing and all those different things. And, seemingly everything's coming up roses for them in terms of what they've done. And listen, through the lens of the stock market, without question, I guess that's the case. I mean, if the only jury was the performance of the S&P 500 and some of these obviously high-flying technology names, they've done a masterful job. But obviously, I do think there's some damage being done under the surface. Now, in terms of Fed rate cuts, there's nothing out there that I see that really is forcing their hand into doing so. I mean, I would submit, they allow things to continue on current path as long as sort of nothing breaks, and nothing seems to be breaking in any way, shape, or form. I think they push it out as long as they possibly can because, again, I believe that these are normalized rates, but that's just me. So we'll see. And I do believe that if they were to make a move to the downside in terms of cutting rates, they're just going to sort of reignite that whole inflation genie, which is out there. Maybe not necessarily in wage growth, but certainly in terms of some of these underlying commodities, ex crude oil. So, we'll see how it plays itself out. And, there's also a supply demand component to bond prices that the market's taken into consideration. So that's why I think you have this sort of push me, pull you in terms of 10-year yields. When supply demand comes into play, obviously you see rates go higher. When I think the strength or relative non-strength of the economy comes into play, I think that's when you see yields start to go lower. And that's what we've been dealing with now, not for the last couple of weeks, but for the last couple of months.
Yeah. And, Danny Moses mentioned this on the Friday edition of the On the Tape podcast, that quantitative tightening is the amount of which they're doing is going down. So you do have, less of that going through. And to your point about a 5.5 on the upper band of the Fed funds versus, let's call it, a CPI at 3.1%, you could make an argument that that is not particularly restrictive at the moment, which makes the case, to your point, Guy, that they could remain higher for longer, right? And you could still have the economy, which, we're going to get, I think, a measure of GDP this week, is still chugging along. Like, let make no mistake about it, right? But you do have this situation where the consumer, you know what I mean, is definitely in focus. Now you have a stock market that's all-time highs. You have a housing market that's stuck, but the values are still very high, right? You have the potential for, homeowners to unlock, huge home equity loans. They're probably not going to do it right here, but that is, on the sidelines, Guy. I know that's a term that activates you a little bit there. But
There are a number of terms that activate me. That happens. Money on the sidelines is one that is thrown out there in an inordinate amount of times on different shows with a question with nothing really to support it, by the way.
by the way, we also, though, do it just to agitate you. Melissa Lee is fabulous at it live on air.
It's the
I mean,
best. It's the
she
best.
she just knows what's going to get you all fired up. But there was an article in Bloomberg over the weekend. Key engines of U.S. consumer spending are losing steam all at
That's
once.
true.
Americans rely on credit as disposable income declines. Fed is hoping for a slowdown, not a breakdown in the U.S. economy. Real disposable incomes have risen only modestly over the past year, obviously, and we have the cumulative effect of inflation. So those are all the things weighing on the consumer. And I just want to make one other point, Guy, that you mentioned about something not breaking. It's interesting that the Fed can stay, course, right? And we've seen this in other past cycles, if you will. But sometimes it's a few things in the stock market that break, that cause these ripple effects throughout the economy. Because if you take away the wealth effect, right, if the stock market goes lower, if unemployment ticks higher, you could say, oh, well, the housing market, well, you lose that too, right? That supply demand dynamic can shift on its head, right? So to me, going back 24 years or so, it was a stock market thing that really caused the economy ultimately to go in a recession. And then obviously the financial crisis was very different. But when I guess the stability of our financial system, or the largest banks in our financial system, were called into question in '07 and '08, you lost everything else, right? The housing market dropped. You had unemployment go higher. You had consumer spending, which you said is just an overlay of the S&P 500, go into the shitter, right? And then you have enterprise spending slow down. And then you have the Fed that goes into the playbook doing the only thing that they know how to do.
It's fascinating to me, and I've mentioned this on our shows and on Fast Money, but I believe this, and I say this term a lot. I'm not suggesting I'm right, but I believe this to be true. And again, I want to emphasize that I understand that the majority of people don't own stocks, so I want to get that out there. But I also believe that people equate the stock market with what's going on in the world. And when the stock market goes up every day, they might say to themselves, man, I know the way I feel. I don't feel great about things, but the stock market must be signaling something. So I'm going to spend money. I'm going to go on that trip. I'm going to buy that car. More granular, I'm going to go to different restaurants. I'm going to go to Starbucks. Those things happen. It's when the stock market takes a leg lower in a meaningful way is when people sort of peek their heads up and say, wait a second, what just happened? Maybe I shouldn't be going on that trip. And again, you can go back in time over the last decades and sort of overlay consumer confidence with the performance of the S&P 500. They really do mirror one another. And consumer spending typically in this country stops on a dime when you see stock market events to the downside. And that's just factually true. So as long as the stock market continues to do well, people will spend money, regardless whether or not they should be. And again, I do believe that people are combating inflation with credit, and the numbers bear that out as well. Now, other people say that's not true. I mean, it depends on the lens you look through, I guess, but there's clearly a dynamic going on that people are strapped. They don't feel great about things. They look at the stock market and say, well, maybe it's just me. Maybe things will start to pick up. But when the stock market turns, to your point, is typically when things that's typically when things take notice in terms of the consumer, and then subsequently the impact it has on the economy.
Right. And, we had a great conversation with Kyla Scanlon on Friday's On the Tape podcast.
Vibe session.
Yes. Well, I want to get into that for a second. So she is the author of a brand new book that came out late last week. It's called In This Economy. And she breaks down in a really simple way a lot of this stuff that we talk about. We're also doing a little bit of a giveaway. The first 100 people who rate and review our show take a screenshot of it, that would be of the On the Tape podcast, send it to contact at risk reversal. We're going to send you a free book from Kyla, which is pretty cool. But Guy, because she's rolling out this book and she was on our podcast, she's probably on some other podcasts. I saw her quoted in Axios. I saw her quoted in the New York Times, about the vibe session. And it's really talking about the disconnect between what's going on in the economy, but the way consumers or people feel about it. And there was this article, and we'll put it in the show notes, from The Guardian out of the UK. Majority of Americans wrongly believe the U.S. is in recession, and most blame Biden. That's always the case. You're going to blame the guy who's in the White House here. Nearly 3 in 5 Americans wrongly believe the U.S. is in an economic recession. The majority blame the Biden administration, according to a Harris poll conducted exclusively for the Guardian. I find this really interesting. I just want to read off some stats here. 55% believe the economy is shrinking, and 56% think the U.S. is experiencing a recession. Though the broadest measure of the economy, gross domestic product, has been growing. 49% believe the S&P 500 stock market index is down on the year. We know it's up more than 10% on the year. So again, 49% believe the unemployment is at a 50-year high, though unemployment is under 4% at a 50-year low. I mean, you can't make this stuff up. You know what I mean? But it speaks to what you're saying, Guy, is that people are looking around and they don't feel great locally, I guess, about what's going on. And I guess on a macro level, things are better. But to your point, maybe it's being masked by credit all over the place.
No, look, and I think those numbers are probably inflated a bit, but I think historically, people's perception of the economy or the stock market or the unemployment rate, it typically comes down to, what they view through their lens, like what they're dealing with. So they sort of obviously, they push that out and they project that in terms of what they think the economy is doing. I think it's worse now in this political climate when obviously you have different factors at work. I mean, there's one side is trying to say how great things have been doing, and there's the flip side of the equation that's telling people how shitty things are. And I do, and again, this is going to sound elitist. It's not meant to be, but quite frankly, I think the majority of the people, and I struggle with some of these things as well, by the way, they probably can't define what a recession is. And that's going to sound like I'm being I'm not intending that to be. They hear the word and they equate that with whatever they're feeling, right? They're paying more for things, so we must be in a recession. They're paying more for things, so the stock market must be down. They're having difficulties paying their bills, so the unemployment rate must be at 50-year highs, not 50-year lows. And I think it comes down to the individual's lot and then the projection out. And it does make sense, but it's also deeply alarming if you really think about what's fact and what's perception at this point.
Yeah, no doubt. We try to kind of differentiate between the economy and the markets because the markets can do things that are just disconnected to the economy. And that is really what I think is being reflected in this poll to some degree. And we forget that, you and I, or people like us, we stare at our FactSet machine from 8 in the morning, till 5 p.m. at night. We talk about this stuff a lot. We're looking at all different sorts of news on a macro level, geopolitical, commodities, FX, credit, right? The list goes on and on. 98% of Americans, and this isn't meant to be elitist either or condescending, but 98% of Americans just don't focus on this stuff the way we do. We think about politics, how that works into it too. You know what I mean? So again, I think we're laser focused on this. A lot of, folks are, just coming to it, to your point, when they look at their balances or wherever the hell they are, they have lower disposable income because of inflation. They have a lower savings rate because of inflation, like that sort of thing. And they want to blame somebody, right? So I get it. You get it. One thing we also try to differentiate, Guy, is between the retail investor or trader experience and that of the pros. And this options story out of Bloomberg caught my eye. Pros are worried about the S&P 500's rally, staying power. Options trader, this is out of Bloomberg, are expressing skepticism about the sustainability of the recent rally. Indicators of market volatility, such as the VIX, have shown mixed signals, with some measures suggesting potential turbulence ahead. We've seen an increase in hedging activity, and I think the most important part of this is that the amount or the cost of hedging against a 10% decline in the SPY in a drop, is near the highest since October. And we know where the market was in October. It was down, 7-ish% or so from its July highs and was about to kind of just go on this major rip or so right up into where we are right now. So when you hear stories like that, when the cost of hedging starts to increase, we have the market at all-time highs. You had that sort of price action that we saw late last week. We saw just in the SPX in the last hour, and then you see the price action in single names, like we just highlighted, some getting taken out to the woodshed, and then other goofy behavior like what's going on in GameStop. Again, it doesn't make you feel particularly bullish.
No, and it's interesting. I obviously that's a factual statement you just made in terms of the numbers, but it's clearly not manifesting itself in the form of the volatility index, which when you do see moves to the upside, which historically the moves last a few trading sessions, maybe even a couple weeks. Now they seemingly last only a few hours. I think that last little spike we saw in the middle of I don't know when we had that downturn. I guess middle late April. I mean the VIX I think got up to 21 or so and it hasn't been cut in half, obviously, but we had a close below 12 a couple different times, and it's probably hovering either side of 12 now. So these are short-lived events. Now, if there are people now buying protection against a 10% downside move, we'll see if that starts to make its way into the larger volatility index, but clearly we're not seeing it yet. It does make sense, by the way, for all the things you mentioned. And although we're seeing, again, in certain sectors and obviously individual names, continued strength, we could look at the transports and you see those rolling over. You mentioned the banks are doing well, but the banks are doing well in the face of a Jamie Dimon a week and a half or so ago saying how their stock is a little expensive at these levels and they're not buying back stock right now. So again, the cross currents are significant. And I mentioned Jamie Dimon, he continues to seemingly on a weekly basis be out there trying to be, I don't know if the voice of reason or somebody trying to show some of the things that can go wrong. But, for the last year and a half, he's been somebody that has deep concerns about some of the things that he sees, which clearly, again, have not made its way into the market. But at a certain point, you say to yourself, what does he see that the market's not seeing? And is he missing something or is he just, in our world a little bit early? But as you know, if you're early in our world, you're wrong.
Yeah, no doubt. Like your football coach used to say, early's on time, guy, but that's maybe just if you're a football player. Carl Quintanilla, you just call him.
I call him Q or CQ.
Yeah, there you go. He just tweeted this out. This is from UBS, their strategist, Jonathan Golub, who comes on our program, CNBC's Fast Money. Nvidia has contributed 34%. The S&P 500's 10.6% year-to-date return. Google, Microsoft, Meta, and Amazon combined account for another 26%. We've been quoting our main man, John Butters, his Earnings Insight blog. He's been talking about this concentration in returns. I think he said that, I don't know, like 92% of the returns is from the Magnificent Seven. And then the other, 492, excuse me, are down about 5% or so. You know what I mean? If you look at that, that's the concentration that I think some of those option pros are trying to protect against. Before we get out of here, I want to get your take on what's going on in the oil patch, not the stocks, but the commodity. You saw OPEC Plus, they're putting some more barrels of oil on the market here. We have crude trading at about $77 or so. So it's not down that much on that headline, but late last week, it kind of sold off or so. Thoughts there, some of the concerns, or maybe the China demand is not coming back as much as expected. I don't know why you put more barrels on the market if that's the case, but thoughts there. I mean, at the end of the day, lower crude will be good for a U.S. consumer, especially as we head into the summer driving season.
Yeah, it's again, you wonder what's going on, excuse me, behind the scenes in terms of, some of the politicking, some of the backdoor agreements being made to try to keep a lid on oil in the face of obviously some of the geopolitical stuff that's going on. I have no idea. But to answer your question, crude oil does not trade particularly well at all. Every time it sort of pops its head up, you see another leg lower. And to a certain extent, I guess that's welcome news to the Federal Reserve because obviously energy is a huge component of some of the things they're trying to combat. We'll see. What's been interesting is in the face of that, the M&A activity that continues to swirl around the industry. So again, you have all these cross currencies, cross signals going on simultaneously, not only in the broader market, but in the energy space. And to your point, quickly going back, now the fact that Nvidia is about 35% of the earnings growth for the S&P 5, I mean, that is a staggering and yet at the same time alarming number that we have brought up a couple different times over the last couple of weeks, and now other people are quoting that as well.
Yeah, and the market just opened here, and Nvidia just gapped up 3.5%. So you can do the math on a $2.8 trillion market cap on just a product announcement. I mean, it's a bit of a feeding frenzy here, and I think that you have two aspects here. You have retail that have just become obsessed. They've made a lot of money in this thing, and they continue to buy it. And then you have this idea of passive investing that unless you are basically at your benchmark rate for this sort of name, you're going to get smoked, right? At any point if you're underweight. So that's in it. Guy, we have a very diverse set of viewers, listeners of all our podcasts, right? Some are teachers, some are scientists, some are work in a pizzeria or drive a truck or do whatever. And we hear from a lot of them. Dentists, we got a lot of dentists here. And so some of these people are doing real jobs, not like you and me staring at our FactSet machine all day. But you know what? If you get done with your job at the end of the day and you like to get a recap of what's going on in the market, what's going on in the economy, some single stock sort of stuff, there's a place that you can go do that. Where would you be doing that right now?
Well, I would find a company like Risk Reversal Media that is on the cutting edge of technology and that recently rolled out something that we call Market Matrix, which takes, again, 4, 5, 6 top stories of the day, throws them into one. Well, you can explain it a lot better than I can, but in anywhere from 5 to 10 minutes, you'll basically get our guy Brunson explaining the top stories of the day. And that drops each day after the close, Dan Nathan.
Yeah, it does. So Brunson is a vibe guy, and we're doing all of this. We curate the stories. We pump them with a few prompts into a generative AI bot. It gives us text, and then we put it into a voice bot, and it comes out sounding really great. And it's like you said, under 10 minutes, you can get up to speed. What happened in the markets? What happened in the economy? So go check out Market Matrix. It's MRKT Matrix in your favorite podcast or wherever you get podcasts. And here's the deal. We're giving away tons of swag, guy. I mean, we're giving away, books. We're going to give away t-shirts. If you go and leave a review for Market Matrix in the podcast store, take a screenshot, send it to contact@riskreversal.com, and we're going to send you a tricked out Market Matrix t-shirt. Just put your size and your address on there with the screenshot. So go follow it, go rate and review it, send an email, get a t-shirt, listen to the pod every day. You'll be smarter for it. All right, guy, we covered a lot of ground here. It is a sad day because the Rangers were this close, even playing as poorly as you thought that they played relative to a better Panthers team. It was the 30-year anniversary of their last Stanley Cup here. It was all coming together. And then a 2-1 loss in Game 6. They were coming back to the world's most famous arena. Game 7 tonight, guy. But
would have been the finality of, again, professional sports is always, listen, only one team emerges victorious in the 4 major sports, and there are only 4 major sports. Please do not throw soccer at me. And again, for most people, I mean, the numbers suggest for most people, they're going to walk away not feeling great about the outcome of the season. For some fandoms, they have to deal with it a lot sooner than others. For you Met fans out there, obviously, I think your lot in life. And for others like us Ranger fans, we've gotten within basically 6 wins of winning the Stanley Cup. A lot of teams can't say that. But as I mentioned earlier, Dan, I take some solace in the fact that the better team did emerge victorious.
yeah, and then the other aspect of it, I know you're going to say it's just June, but you have the Yankees with really the best
Just June.
record. I think, okay, you just said it, the best record in the
Well,
American League.
Yes.
Listen,
Best record in baseball, just in case for those keeping score. But Yankee fans understand it's not about April, May, June, July, August, and September. It's really what it comes down to in October. So that's what we're geared for. And there's an elitism embedded in that, but that's what we've come accustomed to. And Yankees, who have not won a World Series since 2009, one of the longest droughts in their storied history, are long overdue.
Yeah, I was at that deciding game, Guy. It was in the old stadium in 2009, and it was kind of fun. I will tell you this summer, though, there's a little bit of a preview. You're not gonna like what I'm saying here. A little bit of a
You're gonna
preview
say the
of the
Yankees and the
World
Phillies are
Series.
fans. Yeah, I
Yeah,
know. I'm
yeah.
not. Yeah, don't touch
Okay.
the money.
Okay, don't touch the money, and money ain't got no owners, only
Spenders or
spenders.
something.
Okay,
I
you
don't know who Omar or Mello is, but I'm sure
Marlo,
Marlowe.
and
Right.
Omar. All right, well, listen, we are out of here. We covered a lot of ground. We appreciate you guys being here. Go check out the Market Matrix. That's MRKT Matrix. And the best part about it is you don't have to listen to Guy or me. You get to listen to Brunson. We curate the stories. He reads them to you, and you get everything you need to know in under 10 minutes. So thanks a lot for being here, and check it out. See you, Guy.